This video is finding you right before your trading breakthrough. And I'll say that again. This video is finding you right before your trading breakthrough, meaning that you already know and you understand, market concepts. You understand market structure. You understand your strategy, whatever it is. But it's one thing that's holding you back, that's keeping you from becoming that consistent and profitable and disciplined trader. So in today's video, I'm going to be explaining the one thing that's holding you back. If you aren't familiar with me, my name is Mike Lido. I've been day trading for over 6+ years now. Today is day 17 of the Trading Camp series. This is Trading Camp 2.0. If you haven't watched the very first series, the 15-day Trading Camp, go check that out. The link will be inside of the description. And I go over all of my in-depth strategies leading up to this point. So like I said, this video is for the people that feel like they have that trading breakthrough and they want to get to the next level. So let's go ahead and dive right into the video. So in today's video, we're going to be speaking about risk management. Like I said, this is the very most important thing that you will have as a trader. Without proper risk management, without understanding risk, you will never ever be successful inside of the market. And once I understood and I mastered risk management, this was the thing that took my trading to the next level, right? So there are a few key components that I want to talk about when we speak about risk management, right? Now, when we think about risk management, we want to understand that there's a few key pillars that I want to go over, which is your risk tolerance, your risk to reward, percentage risk of an account balance, risk exposure per day and week, and then also understanding stop loss placements, right? So let's go ahead and dive right into it, right? So when we think about risk tolerance, right, this is how much can you mentally tolerate without making emotional decisions that cause you to be too attached to the trade. Meaning that you need to have a sit down and have a conversation with yourself and ask yourself, how much am I willing to risk that won't cause me to sit and look at the trade and stare at the trade? Meaning that if your risk tolerance is $1,000, where you can take a trade and risk $1,000 and be completely comfortable, then that's your limit. But the moment that you increase that from $1,000 to $2,000, and then you begin to, babysit the trade, you begin to sit there and stare at it all day, or you begin to notice that you might close the trade too early simply because, you don't want to give back your profits because you haven't seen that much profit in the market in such a short period of time, because you're not used to risking that much at one particular time. So I want you guys to sit down and ask, how much can I withstand without getting emotional involved? Right? So I want you to sit down with yourself and ask yourself that, right? Now, of course, this does take some reflection. This does take a lot of awareness, right? You have to honestly be aware with yourself to see those things and notice those patterns. But once you sit down and ask yourself and really understand that, then you can get a better understanding of, okay, I can risk this amount before I actually go into tilt mode, or before I begin to, spiral out, whatever the case may be, right? Now, going into risk to reward, this is just, this concept is just basic trading terminology. So in trading, you have risk to reward. This is how much you're aiming to gain and compare it to what you're risking. Meaning that if you're risking 1-to-1, that means that you're risking the same amount that you're looking to gain. So if you're risking $1,000, that means that you are looking to gain $1,000, right? So risk 1K to make 1K, right? That's what a 1-to-1 risk to reward is. A 2-to-1 risk to reward is if you risk $1,000 to make $2,000, right? And then a 3-to-1 risk to reward is if you risk $1,000 to make $3,000. So as a trader, you want to have the highest risk to reward possible in order for you to not necessarily have to win as many trades. Meaning that if I win 3 trades at a 3-to-1 risk to reward, I can have a lower winning percentage in comparison to somebody that has a 1-to-1 risk to reward. Meaning that if somebody has a 1-to-1 risk to reward, they're going to lose the same amount as they make every single time. So if they risk 1,000 and then they make 1,000, then they lose 1,000, they're at break even. Versus the person that risked 3,000, that risked 1,000 to make 3,000, they win one trade, they're up 3K. And then they lose one trade, now they're down 1,000. So 3K minus 1,000 equals 2,000. So they didn't have to take as many trades or win as many trades to become profitable in the end. So the goal is for you to have a higher risk to reward, but it's one important concept that I want to go over at the end of the video that most people overlook. Like, I know a lot of people tell you, like, yes, have the highest risk to reward, but you still have to make the risk to reward make the most sense. And like I said, that's what I'm going to talk about at the end of the video, because it is by far the most important thing that you will endure as a trader, because most people, like I said, they just overlook this, right? Now, speaking of percentage risk of account balance. Now, me personally, this is what I always tell my students. This is what I tell people inside my Telegram trading community, so forth and so on. I suggest that you risk 5% max, right? Now, of course, this is subjective depending on your skill level. Now, there are times where I might risk 10% on one particular trade if I'm very confident, right? Now, I don't do this very often, but there are times when I do this. And like I said, this is based on skill. This is based on your confidence and how much you are willing to acceptingly lose in that position without, you being, completely tied to the position, right? So this is kind of like your risk tolerance. So when you risk 5% max, though, I want to put this into perspective. And this is how I learned. This is how I approach the markets from an investment standpoint, right? So if I risk 5% on my trades max, this is like I said, max. And me personally, I like to take 2 to 3, maybe 4 trades a week, right? So if I'm risking 5% on each trade, I can then make 10 to 15% easily off of 2 to 3 trades in hopes of, like, if I win all 3 trades, then I'll make 15%. If I go 2-1, then I'll make 10%, right? Now, 10% compounded over a month, that's 40%, right? And then compound that over a year, you do the math, right? So those are huge gains and not risking a whole bunch. So you don't have to go and risk 50% of your account all at one particular time because, you're trying to scale your account, you're trying to grow your account. Like, no, you don't have to do that. You simply just have to have the skill set in order to take a position, place your position in your stop loss in the correct area where you know that if it gets hit, you're completely wrong, which we'll talk about in the end of this video, and understand that you will practically have to lose 15 to 20 trades in a row to lose your whole account, risking 5%, right? So with that being said, I like to risk 5% max, and we'll go into a little bit of detail about that here shortly. All right. Now, the next thing, I want you guys to set a limit of how much you're willing to lose in a day/a week before you stop trading. Meaning that if you set your risk exposure to 10% in a week, this means that if you are risking 5% per trade, you can only lose 5%. You can only lose 2 trades that week before you have to stop trading. But now, this is where most people overlook this, right? So in trading, you have to have a set of rules. You have to have rules for yourself. So think about it like a job. Your boss tells you rules on things that you can and you cannot do. But where most people go wrong in trading is that they want the freedom so bad that they don't have a set of rules implemented in place. So in this case, you have to set your rules. So you have to set your risk exposure per day, per week. Oh, you have to set your account percent risk of your account balance, right? You have to set your risk to reward. You have to set your risk tolerance, so forth and so on. So you always have to set rules in place in order for you to get to the next level in trading, right? Now, one thing that I want to talk about for percentage risk of account balance. This is simple math, but this is how you will calculate your lot size, right? So this is account size times the percentage you're willing to risk times your stop loss distance times your lot size, right? Meaning that if you have a $1,000 account, and you're looking to risk 5%, right? So you're going to times that by 0.05%, right? So let's just do the math here. So if I have 1,000 times 0.05, that means I'm risking $50, right? I'm risking $50. So since I'm risking $50, I now need to turn that and see how much of my stop loss, my stop loss is. Meaning that if I have a stop loss is 50 pips. This means that my lot size will be a 0.10, which is $1 per pip, right? So you're probably wondering, how did I get that? So I took my stop loss distance, right? I understood how much I'm willing to risk, and then I did the math for my lot size, right? So if my stop loss distance is 50 pips, like I said, then I need to calculate what lot size is equivalent to $50, meaning that 50 pips. So 50 pips, and sorry, I'm not really the best with explaining this, but 50 pips and understanding my lot size. Understanding how much I want to risk. So $1 per pip times 50 pips equals $50 risk, right? If I wanted to risk $100, then and my stop loss was 50 pips, guess what? I would take $2 per pip, because $2 times my $100, divided by my $100 risk equals my overall lot size that I will use, right? So you always want to look at your account size, how much you're willing to risk, what's your stop loss distance, and then that will give you your overall lot size. So to put that into perspective, 0.01 equals 10 cents per pip. A 0.10 equals $1 per pip. 1.0 equals $10 per pip. And then a 10 standard equals $100 per pip, right? So if you take that and understand how much your lot size is in comparison to how many pips you are risking, you can then find out what lot size you need to use, right? Now, this is going to tie into exactly what we're about to talk about here, right? So you need to ask yourself, do I know exactly how much I'm risking on every single trade, or am I just clicking a lot size that feels right? Now, mind you, if you get this wrong, nothing else matters. I swear, if you do not understand risk management, you do not understand using your lot sizes correctly, you will not make it in trading, point blank, period. And where most traders go wrong, they are basically gambling because they see a trade, right? So let's look at gold down here. They see gold down here and they're like, oh, well, I'm going to just jump in with a standard lot size. And then let's just say they have a $10,000 account, and then the stop loss goes beneath here, which is almost 400 pips. And they're like 400 pips times the standard is $10 per pip. So that's $4,000. $400 that they're risking And it's like, bro, you risking, I mean, not $400, $4,000 that they risking, and that's 40% of that account balance. So 4,000 is 40% of 10,000. And most people just jump into trades because they like, oh, well, I'm gonna just jump in, but they don't really understand how much is at risk, right? So this is gambling in trading, right? So most people, like I said, they do those things, or they say, I just use the same lot size every single time. And they don't really understand how much is at risk, because one trade might be 50 pips, one trade might be 100 pips, and one trade might be 200 pips stop loss, depending on the pair that you're trading. So you can't go into trading with that mindset and just expect that you're going to, make a whole bunch of profit, right? Now, one thing I want you guys to think about is I want you to think about trading in the terms of risk and not dollars. So meaning that if I had a 1R, which is a one risk to reward, the amount that I'm willing to lose, 1R equals the amount that I'm willing to lose on that trade, right? So that means how much am I willing to risk? If I win 3R, that makes much more of a difference than saying that I made $300, right? Because $300 could have became at a 2-to-1 risk to reward, 3-to-1, or even a 0.5 to risk to reward ratio, right? So the money aspect in trading does not necessarily matter. What matters is how much you are risking in conjunction to how much you are going to potentially make on that position, right? And just to reiterate what we talked about with our position sizing, like I said, it's just simple math. Start with your account size, decide the percentage you're willing to risk, measure your stop loss distance in pips, and then that combo will tell you your overall lot size, like we kind of just explained, right? Now, to reiterate, where most traders struggle, they randomly choose a lot size based off their emotion, right? So if you've been on a 3-trade win streak, you might feel like, oh, I should up the lot size. And then boom, you take a bigger loss that you couldn't fathom because your risk tolerance wasn't that high. You couldn't mentally tolerate that big of a loss, or you couldn't mentally tolerate that big of a drawdown. So that's where I see a lot of people go wrong, because they don't really understand the concept of sticking to a certain risk to reward and not just randomly choosing lot sizes based off of their emotion or their recent losses, right? And they only find out how much they really risk after they lose. So this is one of the scenarios where you just jump in a trade and then you place your stop loss and you come back, you're like, damn, like I didn't expect to lose 3,000. I was only expecting them to lose like 1,000, but they didn't really do the math before placing a trade, right? Now, another thing that I see is people will size up when they feel confident and then size down when they are scared, right? Which is, in a sense, backwards, right? Because if you're having highs and you're feeling super, good about the market, that's a sign that you should size down. Why? Because most people go wrong in trading when they actually feel the best. Like when they're on a winning streak, that's when they end up taking the biggest losses, because they then go to up in their lot size, they then go to over trading, so forth and so on. And then when they're losing, they want to lower the lot size and trade very scared instead of just trading their overall original plan, right? So like I said, if you do not understand this, nothing else matters in trading, right? Now, the next thing I want to talk about is stop loss, because this goes hand in hand with your risk management. If you do not have your stop losses in the right places, ladies and gentlemen, it does not matter what your risk management is, I promise you, right? So let's put this into perspective. So your stop loss goes where my idea is invalid, not where my emotions feel safe. Meaning that if I have structure is being formed like such. If I take a buy, and let's turn this alert off. If I take a buy here, ladies and gents, if I take a buy here, I am not placing my stop loss like this and hoping that it does not get hit before continuing. That, ladies and gents, is gambling, right? So this is, when people do stuff like this is because they over leverage and they want to look on a 1 minute time frame and say like, okay, well, if it breaks on this, I'm gonna just get out or let it close me out. And it's like, no, like you want to place your stop loss in an area where if it hits your stop loss, you are completely wrong. So in this case, if I take a buy, my stop loss goes beneath this higher low point here. Why? Because if I break this higher low point, that is a shift in the structure telling me that the market wants to now go from an uptrend into a newfound downtrend. Why? Because we broke structure. So that is where your stop loss placement goes. So like I said, people place stop loss because they over leverage, or they say, oh, I don't want to lose too much. Or they'll say, all right, I'm in this trade now and I over leverage my account and my stop loss is super tight, but then I see it, retracing and it's coming down, but I don't want it to hit my stop loss. So let me just extend it just a little bit more, and then extend it a little bit more and extend a little bit more. And by the time this gets all the way down here, ladies and gents, your account is blown because you already over leveraged. Why? Because your original stop loss was super penny tight, right? So that is where 90% of traders go wrong, because they don't really understand the proper risk, and they also don't have the proper stop loss in place to know that they're wrong about the position. And then what's worse is if you don't even have a stop loss at all. If you say you're going to manage your stop loss manually, that's just a recipe for disaster, because now you're allowing yourself to be susceptible to making emotional decisions. Meaning that if you didn't have a stop loss and you're like, all right, I'm going to just watch it. I'm going to set alert. And then it comes down here and you're like, all right, I don't know if I'm going to get out. Now it's like you have to literally make a decision to say, am I going to get out here or am I going to hold it? But guess what? Now your emotions are leading your decisions versus letting the technicals or the market lead your decision. Because if you place a stop loss and it hits the number value of your stop loss, the market takes you out no matter how you feel about it, right? But if you don't place a stop loss and then it goes to that area and then you're like, oh shoot, I'm gonna just hold because I don't want to lose this much. Now guess what? You in a doom cycle of emotional based decisions, right? So what I want you guys to do is I want you to use structure to set your stop loss, right? Meaning that you're going to set your stop loss in an area that is beyond a key level or above or below a clear swing high or swing low, and outside of the area where your setup is valid, right? That way, if your trade hits that stop loss, your trade thesis is done, basically meaning that your trade is invalid, right? So place your stop losses in areas where your trade will invalidate itself, not where you want to place it based off of your emotions, right? So where most traders go wrong is they treat stop losses as a suggestion and not a rule, right? They put their stop loss closer, like I mentioned before, so they can use a bigger lot size in hopes of making more just to avoid being stopped out, right? And then they'll move their stop losses to avoid being stopped out, right? So stop losses are part of the game. Your trades are going to hit stop loss. Sometimes you're going to be wrong. It's just like basketball. You're not going to make every shot, and that's just the reality of it. So if you accept that as a part of the game, then you can then move with the correct intention and the right focus inside of the market, when understanding that you don't have to over leverage. You don't have to place your stop loss right beneath the candlestick. Like, you place your stop loss in validation areas, and you determine your risk management based off of set percentage rules, based off of the rules that you set for yourself inside of the market, right? Now, another thing, risk management does not stop at one particular trade. So most traders only think in single trades. How much am I risking on this one particular setup? All right. But where most people go wrong is they can have a bad day, and then that will turn into a revenge session that will then turn into a upside down tilt week. Right. So there are a few rules that I'm going to leave you guys with before I let you guys go. And that is, like I mentioned before, you're going to have a daily loss limit, right? A daily loss limit and a weekly loss limit. So you're going to set these rules. You're going to have a drawdown limit, right? So this is going to tell you how much you're going to say, I'm going to stop, before, if I hit this drawdown limit during this week, then I'm done for the week. I want you to have a trade count limits, meaning that you have so many trades that you can take a day. Because sometimes I see people, they'll take 20 trades in a day. And me personally, I think that is outrageous, right? And this is where people go wrong with these prop firms as well. Prop firms enforce all of these rules that I'm telling you to do. And guess what? Most people don't follow the rules. Why? It's just in human nature, right? So that's why prop firms are able to just literally take your money from you, because y'all don't follow rules. So you, as a trader, if you want to become a professional trader, you just want to make this, your livelihood, or your main source of income, you have to put rules and systems in place so that you can then follow them and make trading a living, right? You have to have rules. Just like any job that you work, any society you live in, like there's laws. Like in America, there's laws that you have to follow in order to keep things in order. At your job, there's rules you have to follow in order to keep things in order. In trading, it's the exact same way. There's rules that you have to place in order for you to keep things in order. Without you having those rules in place, I promise you, ladies and gents, you will not be able to make consistent money. So with that being said, ladies and gents, I hope this video was super helpful for you guys. Let me know in the comment section, what are you going to do with your risk management going forward into the year 2026 that will improve your trading going into the next year. So with that being said, I love you, Chart Runners family, and make sure you guys hit the like and subscribe button, and I will see you all in the next Trading Camp series.